Have you ever felt like you're looking through a kind of foggy window when you try to figure out how well a company is actually performing? You get a glimpse from those big earnings numbers they shout from the rooftops.
Yeah.
But it's not really a crystal clear picture, is it? If you've ever dug into your financial sources and felt like something's hiding in the shadows,
hmm
well, we're diving into that today.
That's right. We're going deep into a book that gives you the tools to see past the surface and really understand what's going on with a company's profits. And the cool thing is, even though this book was written quite a while back, the advice is still incredibly relevant today.
We're talking about quality of earnings, the investor's guide to how much money a company is really making.
By Thornton O'Glove.
Exactly, with Robert Sobel. Published back in 1987, this book is all about becoming a much sharper reader of financial information.
Absolutely.
And in this deep dive, we're going to extract the most important insights from O'Glove's work. We're going to look at why he's so skeptical of analysts and auditors, how different ways of reporting earnings can paint very different pictures,
Yeah.
and how those financial ratios can reveal a company's true financial health. We're arming you with the knowledge to be a much more informed investor.
That's the goal.
All right, let's jump right into it. O'Glove doesn't hold back in his book. And right off the bat in Chapter 1,
Oh, yeah.
he throws down the gauntlet with the title, Don't Trust Your Analyst.
Oof.
Now, he's not saying all analysts are out to get you,
No.
but he is saying there are some built-in reasons why you shouldn't just blindly follow their recommendations. You got to take them with a grain of salt.
It's really about understanding the environment that analysts work in, right?
Oh.
You got to think about the pressures they're under. For example, their firms might have these big investment banking relationships with the companies they're covering. So does that create a bit of a nudge, a push to be extra positive?
That's a really good question. I mean, back then, data from Zacks investment research showed that analysts were dishing out buy recommendations like candy. So you got to wonder, can every company truly be that fantastic?
It does make you think.
O'Glove actually tells this interesting story about an oil analyst who was always super negative,
Interesting.
which at first glance you might think is a good thing, right? A contrarian perspective.
Yeah,
But it highlights how even a bearish stance can be driven by personal gain. It's a reminder that self-interest can color anyone's viewpoint.
absolutely. You got to look for those underlying motivations.
And it's not just about making money from trading, right? O'Glove really emphasizes this pressure on analysts to keep those companies happy, to keep that flow of information coming. After all, they need access to management, to those inside scoops. He even says that analysts are often expected to be positive when their firm's investment bankers are trying to get those companies as clients, trying to close deals. Talk about a tightrope walk.
It's a delicate balance for sure. Imagine what a harsh report could do to those relationships.
No kidding. And O'Glove pulls in a wider perspective here, referencing this review in Financial World that found a pretty disturbing trend.
What was that?
Well, it turns out that top analysts often recommended buying stocks right before the market peaked
Oh, wow.
and selling them right before it hit bottom. Makes you think, doesn't it? Who are they really working for?
That's a tough one.
There's also the story of Daniel Mead, a well-respected household products analyst who dared to issue a sell recommendation on Mattel.
Brave man.
And guess what? He faced a ton of pushback and ended up losing valuable contacts in the industry. Talk about the price of going against the grain.
That's the cost of being a contrarian sometimes.
And those challenges aren't limited to individual cases either, right?
Yeah.
James Chanos faced a ton of resistance and even investigations just for being skeptical about Baldwin United, which turned out to be justified skepticism, I might add.
Right.
O'Glove takes us even further back, reminding us of Leslie Gould's reporting during the 1929 crash, and George Salem's struggles to issue negative ratings within his own firm.
Wow.
It seems this pressure to be positive has been around forever.
It's a recurring theme in finance.
The big takeaway here, when you're looking at those analyst reports, is to be aware of these underlying pressures and biases. Don't just assume a buy recommendation is based solely on how strong a company really is.
Exactly. It's not about ignoring analyst reports entirely, but it is about reading them with a critical eye, with the context in mind.
All right, so we've got to be skeptical of analysts, but what about the auditors? You know, the ones who are supposed to be the independent watchdogs, making sure those financial statements are accurate. Well, Chapter 2 of Quality of Earnings raises some eyebrows with its title, and Don't Trust Your Auditor.
It seems a bit counterintuitive, doesn't it? You'd think these are the folks we should trust the most, the ones ensuring everything is above board. So why the warning?
The key point O'Glove makes is this. Mm. Who hires the auditors? Who pays them?
The company itself.
That's right. The company being audited is the one footing the bill. And that creates a very particular dynamic, doesn't it?
It certainly does. You can see how there might be pressure to keep the client happy.
Exactly. And O'Glove goes through the different types of audit opinions you might see. A clean opinion, a subject to qualification, and except for qualification, and a disclaimer of opinion. But here's the thing. He stresses that even a clean opinion isn't a foolproof guarantee. He even quotes advice from a Drexel Burnham Lambert pamphlet, saying that you should check out the auditor's opinion first thing.
Interesting. So even the best case scenario isn't a sure thing.
To make things a bit more unsettling, he provides some examples that'll make you raise an eyebrow or two. He talks about this surge in shareholder lawsuits against auditors for negligence. Apparently, in the summer of 1985 alone, the major accounting firms paid out a huge amount of money in settlements for audit-related cases.
Wow, that's a lot of settlements. It definitely suggests some oversights, doesn't it?
It does make you wonder. And then there's this practice called opinion shopping. It's a bit shady, where companies actually look for auditors who are known for being a bit more lenient.
So they're not really looking for an independent assessment. They're looking for someone to rubber stamp their financials.
Exactly. The SEC even issued a warning about this in 1985 because they were worried that auditing standards would drop if companies just went shopping for the easiest opinion.
Makes sense. It undermines the whole point of an audit.
O'Glove also brings in Professor Abraham Brilloff, who was a very vocal critic of the accounting profession. He was really concerned about the whole system.
What did he have to say?
Well, he had this example of Arthur Young & Co., who issued a qualified report for Penn Square Bank, and then shortly after, the bank collapsed. And there was a similar situation with Pete Marwick and some banks in Oklahoma City. It really makes you question the effectiveness of the whole auditing process.
Those are some serious red flags.
Brilloff was so worried about the potential for things to go wrong that he actually said audited statements should have a little skull and crossbones on them.
Whoa, that's pretty dramatic.
Dramatic, but it gets the point across, right? He wanted investors to understand the inherent risks. So the lesson here is that when you see an auditor's opinion, take it with a grain of salt. Auditors are human, they can make mistakes, and there are always pressures and potential conflicts to keep in mind.
Definitely. Knowing the ins and outs of that auditor-client relationship is key to understanding those opinions.
All right, let's shift gears a bit and talk about another crucial source of information for investors. The shareholder letter, that direct communication from management. In Chapter 3, Person to Person, a shareholder letter, O'Glove gets into how to read between the lines of these messages.
You always have to remember that these letters, while potentially insightful, are inherently optimistic. Management wants to present the best possible picture of the company. So your job as a savvy investor is to see past the positive spin and spot any discrepancies or subtle warnings.
It's like deciphering a code, looking for those hidden clues.
Exactly.
O'Glove has some great examples to illustrate this. Let's take International Harvester in 1980. The CEO's letter was all about their long and illustrious history, how they were set for a bright future. It sounded pretty reassuring.
Sounds promising.
But then you look at the actual financials, and you see declining earnings and a mountain of debt. O'Glove points out this disconnect, this gap between the sunny narrative and the worrying numbers, as a big red flag that investors should have noticed.
It's a classic case of words versus reality.
Another interesting case is Apple in the mid-1980s. Management was publicly saying they could coexist with IBM, but at the same time, reports were coming out about slowing sales, plants closing, and layoffs. The shareholder letter was painting one picture, but the reality on the ground was very different.
It's a good reminder to always cross-check the story with the numbers.
And then there's Coleco, with all the hype around their Atom computer. Their shareholder letters were full of rosy projections and grand plans.
Yeah, I remember that.
But what happened? Massive losses, inventory write-offs, and a qualified opinion from their auditors. It shows how risky it is to just take management's word for it.
It's a cautionary tale for sure.
This ties into what O'Glove calls differential disclosure in Chapter 4. He points out that companies might be more optimistic in some reports than others, like maybe they'll be super upbeat in the annual report that goes out to all the shareholders, but then a bit less rosy in the 10-K they file with the SEC. He gives examples like Workslate, Megaframe, CVGT, and ACI, where these inconsistencies hinted at problems brewing beneath the surface.
So the takeaway is to look at multiple sources, right? Compare what they're saying in different reports and look for those contradictions.
Exactly. Don't rely on just one snapshot. Get the full picture. O'Glove also points out that sometimes the most critical information isn't even in these official communications. He mentions Texas Commerce Bank shares, which looked great on paper but was actually under investigation for insider loans, something you wouldn't have known from their public statements.
So sometimes the most important information is what they're not saying.
Exactly. And then there's a whole issue of non-operating and non-recurring income, which O'Glove covers in Chapter 5. He uses examples like PP's unusual charge and Sears' different ways of interpreting tax benefits to show how one-time events or accounting adjustments can sometimes make a company's performance look better than it actually is. It's all about distinguishing between real, sustainable earnings and those temporary boosts.
You got to look for the core business performance, the stuff that's going to keep the company going in the long run.
Exactly. So when you're reading shareholder letters and other company communications, be critical, be skeptical, look for inconsistencies, compare different reports, and remember that management always has an incentive to present the best possible image.
It's about being a detective, digging deeper, and not just accepting the story they're telling you at face value.
Now, let's move on to some really practical tools that O'Glove gives us in Chapter 8, accounts receivable and inventories. These are two key ratios that can reveal a lot about a company's efficiency and potential hidden problems.
What I love about these ratios is how simple they are, yet they can provide such powerful insights. And O'Glove stresses the importance of looking at them over time to see if there are any worrying trends emerging.
Right, it's all about those trends. With accounts receivable, one key thing to look at is days sales outstanding. If that number starts creeping up, it could mean the company is having trouble collecting payments from its customers, which can put a strain on cash flow.
And that could even be a sign of deeper issues, like customers having financial problems themselves and not being able to pay their bills.
Exactly. Now, when it comes to inventories, O'Glove says that if inventory levels are growing much faster than sales, it could be a warning sign. Maybe the company is producing too much stuff that's just sitting around becoming obsolete, or they're overstocking in anticipation of sales that never materialize. And that ties up a lot of capital and could lead to big write-downs in the future.
It's like having a closet full of clothes you never wear. It's taking up space and not doing you any good.
And O'Glove provides some really good examples of how these ratios have predicted trouble for companies. Like there's Commodore International in the early 1980s. He points out the situation where their raw materials inventory was shrinking, but their finished goods inventory was growing. He calls this negative inventory divergence. And it hinted at potential issues even though their reported profits were increasing.
So it's a reminder to not just look at the income statement, but to also dig into the balance sheet and see what's happening with those assets.
Absolutely. He also mentions Apple Computer in the mid-1980s, where their inventory was ballooning compared to their sales. And that ended up preceding some tough times for the company.
It seems like a common theme, right? This imbalance between what they're making and what they're actually selling.
And it wasn't just those two. O'Glove points to Varian Associates as well, where this gap between sales and the rapid increase in both accounts receivable and inventories turned out to be a pretty accurate predictor of future losses.
It's like those ratios were flashing a warning sign.
Exactly. And then you have companies like Thai Communications and Texas Instruments, both showing signs of inventory growing faster than sales, which suggests they might have been having trouble moving their products. Even Wang Laboratories eventually admitted that their inventory was too high compared to their sales.
It's amazing how often these imbalances show up before a company really starts to struggle.
O'Glove even highlights Raycom, where their raw materials and work-in-process inventory was increasing much faster than their finished goods inventory, which could mean their production wasn't aligned with actual demand. Another subtle red flag.
So the lesson here is to really pay attention to these ratios. See how sales, accounts receivable, and inventory are moving in relation to each other. Are they in sync, or are there any big discrepancies that might point to underlying problems?
Now let's move on to Chapter 9, where O'Glove tackles debt and cash flow analysis. He really emphasizes how important it is to understand how much debt a company has and how good they are at generating cash.
It's not enough for a company to just be profitable on paper, right? If they're drowning in debt or can't generate enough cash to keep the lights on, their long-term survival is in question.
Exactly. O'Glove talks about some key ratios here, like the long-term debt-to-equity ratio, which tells you how much of the company's financing comes from borrowing versus investments from shareholders. A high ratio generally means they're taking on more risk.
Makes sense. More debt means more interest payments, which can eat into their profits.
Right. And he also highlights the times interest earned ratio, which measures how easily a company can cover its interest expenses with its operating income. A low ratio means they might be struggling to make those interest payments.
It's like looking at your own personal finances. If you're barely scraping by to make your credit card payments, that's a sign you need to make some changes.
And as always, O'Glove provides some good examples. He brings back International Harvester, which is now called Navistar, to show how big interest expenses can really eat into a company's pre-tax income. It's a stark illustration of the burden of debt.
It's a real drag on profitability.
He also talks about Thousand Trails, a company that had piled up a ton of debt and was basically relying on more borrowing just to cover its day-to-day expenses. Their debt-to-equity ratio was skyrocketing, which raised some serious concerns about their financial stability.
It's like a vicious cycle, right? They're digging themselves deeper and deeper into a hole.
Exactly. Now, back in 1987, the concept of a cash flow statement wasn't as standardized as it is today. But O'Glove does touch on the statement of changes in financial position, which was kind of a precursor. He uses Kellogg as an example of how you can use this statement to figure out where a company's money is coming from and where it's going, even mentioning a method developed by Professor Bernstein to analyze this data in a more meaningful way. The key takeaway is to look beyond just the reported profits and see how much cash the business is actually generating and using.
It's about understanding the flow of money in and out of the company.
So the lesson here is to not just focus on the income statement. Look at the balance sheet to see how much debt they have, and, if you can find it, the cash flow statement to see how good they are at generating cash from their operations.
These are essential pieces of the puzzle when you're trying to assess a company's financial health.
Now, O'Glove also touches on a couple of other important topics. In Chapter 10, Dividends, the Tender Trap, he warns against putting too much emphasis on dividend yield.
It's easy to get lured in by a high dividend yield, thinking you're getting a great return.
Right, but O'Glove explains that sometimes a really high dividend yield can actually be a red flag. Some companies might keep paying those dividends or even increase them, even when they're facing financial difficulties. It's a way to try and prop up their stock price and make investors happy, but it might not be sustainable in the long run. He uses ITT as an example, where they kept increasing their dividends even though their core business was struggling, and eventually they had to cut them.
So it's a reminder that dividends aren't always a sign of strength. You have to look at the bigger picture.
And in Chapter 11, the importance of understanding accounting changes. He emphasizes how changes in a company's accounting methods can have a big impact on their reported earnings.
Yeah, that can be tricky. A change in accounting policy doesn't necessarily mean the business itself has changed, but it can make the numbers look very different.
He gives an example of two hypothetical companies using different inventory methods, LIFO and FIFO, and how that choice can affect their reported profits, especially when you have inflation or deflation. He also mentions the different depreciation rates used by Gelco Corp and the impact of IBM's switch to straight-line depreciation. The point is that you have to understand these changes so you can compare financial data from different periods and get a true picture of the trend.
It's about making sure you're comparing apples to apples.
Exactly. Finally, in Chapter 12, Coming Clean After the Big Bath Indoor Restructuring, O'Glove talks about how companies sometimes take these massive write-offs in one period to make their future earnings look better.
It's like cleaning house, getting all the bad stuff out of the way so you can start fresh.
He calls this big bath accounting. And it can make a company's past performance look worse than it actually was. But it sets a lower bar for future earnings growth. He mentions companies like Allied Signal, Cigna, and Ralston Purina as examples of companies that went through big restructurings, which probably involved these kinds of write-offs. It's something to be aware of when you're looking at companies that are trying to turn things around.
You got to be careful not to get fooled by those sudden improvements.
Now, in addition to all the insights from O'Glove's book, we also have some extra information about why auditors sometimes miss those financial irregularities.
Yeah, this adds another layer to O'Glove's warnings. One big factor is that auditors rely heavily on information from the company's management. If those managers are intentionally misleading them or engaging in fraud, it can be very difficult for auditors to catch it, even if they're doing their due diligence.
So it's a matter of trust, but also a matter of how sophisticated the fraud is.
Right. And another point is that auditors often focus on whether the company is consistently applying accounting principles, but they don't always dig into the economic substance of those transactions. A company might be following the rules technically, but the financial statements still might not reflect the true economic reality of the business.
It's like focusing on the letter of the law, but missing the spirit of it.
Exactly. And then you have the increasing complexity of business transactions these days, which makes it even harder for auditors to scrutinize everything. The financial world has become so intricate that it's a real challenge to examine every detail.
It's like trying to find a needle in a haystack.
And then there's this pressure that auditors face when a client threatens to take their business elsewhere. Losing a big client, especially one that also pays for other non-audit services, can be a real hit. So auditors might be hesitant to be too critical or issue a qualified opinion.
It's a conflict of interest that can really compromise their independence.
And lastly, while regulatory bodies like the SEC play a vital role in overseeing financial reporting, they have limited resources. They can't possibly catch every instance of inaccurate reporting, given the sheer number of companies they're responsible for.
So it's like they're playing a constant game of whack-a-mole.
Too much.
So let's wrap things up. What are the key takeaways from Thornton O'Glove's quality of earnings?
The big message is that you have to think critically when you're looking at financial information. Don't just take those earnings numbers at face value. Dig deeper, understand the potential biases of analysts, the limitations of auditors, scrutinize those management communications, and really analyze those key financial ratios.
It's about being an informed and skeptical investor, not just a passive recipient of information.
Absolutely. This deep dive, guided by O'Glove's principles, is all about giving you the tools to ask the right questions and conduct thorough due diligence.
By using these insights, you'll be in a much better position to assess the true quality of a company's earnings and make smart investment decisions.
You'll be able to see through the fog and get to the heart of the matter.
So here's a final thought for you to ponder. Now that you have this new understanding of skepticism, financial reporting, and those powerful ratios, what might you discover when you go back and look at your own sources with fresh eyes? Think about how those examples from O'Glove's book might still be playing out in the financial world today. It's time to put those analytical skills to work and see what you can uncover.
Happy hunting.